You know that feeling when the market dips and you wonder if it's maybe a chance to snag a bargain?
Yeah, that buy the dip idea.
Exactly. Well, today we're going to unpack a specific way to think about that, a strategy called mean reversion.
And we're focusing specifically on how it might apply, in theory, to trading India's Nifty 50 index.
Right. The core idea we're exploring, based on an ideal scenario for this strategy, is pretty interesting.
It really is. It's this concept that after a big move, up or down, prices often tend to, well, gravitate back towards their average.
Like they're snapping back to the middle.
Sort of, yeah. We're looking at how you might try to capitalize on those temporary drops in the Nifty, assuming the conditions are right.
Okay. So our mission here is to give you a clearer step-by-step picture of how this mean reversion thinking might work. A potential shortcut to understanding one approach for the Nifty 50.
Let's dive in then. The basic principle is looking to buy when the Nifty's price has dropped, quite a bit below its recent average.
Expecting it to bounce back.
Precisely. But it's important to stress this tends to work better when the overall market is kind of stable or already moving upwards.
Okay, step one then must be figuring out that bigger picture and what exactly we mean by average.
You got it. First, you glance at the bigger time frames, like the daily or weekly charts. Is the Nifty generally trending up, or is it maybe just range-bound, stuck between levels?
You need that context.
Absolutely. Then you identify that mean, or average. Common tools are simple moving averages, like the 50-day and the 200-day.
Those smooth out the price action.
Right, or exponential moving averages, the 20-day, 50-day EMAs, they react a bit faster. And Bollinger Bands are useful too. The middle band is just a 20-day SMA.
And VWAP for intraday.
Yeah, volume-weighted average price can be handy for shorter terms. The key is seeing a significant dip below whatever mean you're watching.
Not just a little wobble.
No, like maybe the price actually touches the lower Bollinger Band, or it's, say, 2 or 3% below the 50-day SMA.
Can you give us a hypothetical example?
Sure. Let's imagine it's April 2025. The Nifty's in a decent long-term uptrend, maybe above its 200-day SMA at 21,800. The 50-day SMA is sitting at 22,300.
Okay.
And the lower Bollinger Band is around 22,100. Now, let's say the price dips down to 22,050.
So it's gone below the 50-day and it's right near that lower band.
Exactly. That's a potential signal. It might be getting oversold.
Okay, so the price has dipped significantly. What's step two? We need more proof, right?
Yes. Step 2 is confirming potential oversold conditions. Is the selling maybe getting a bit exhausted?
How do we check that?
We use other tools like momentum indicators. The RSI, Relative Strength Index, is a popular one. If it drops below 30 or even 25 for a stronger signal, that suggests oversold.
Like the market's run out of steam downwards.
Kind of. The stochastic oscillator is another one. Below 20 is the typical threshold. And like we said, price hitting that lower Bollinger Band is another clue.
What about chart patterns?
Yeah, sometimes you'll see specific candlestick patterns forming near the low things, like a hammer or a bullish engulfing pattern, maybe a doji. They can hint that buyers might be stepping back in.
So back to our April 2025 example. Nifty at 22,050.
Right, so it's near the lower band. We'd then check the RSI 14. Let's say it is showing 28, so below 30.
Okay, that fits.
And maybe, just maybe, we see a hammer candle forming right there, perhaps on slightly lower volume than usual, which can sometimes happen at turning points.
Got it. Dip, oversold signals. What's step three? There's more to it, I assume.
Definitely. Step 3 is crucial, checking the broader market context and the level of volatility.
Right, you don't want to buy into a dip if the whole market is tanking hard.
Precisely.
Yeah.
You need confirmation the overall market isn't suddenly turning very bearish. Stable or bullish is what you want. And volatility, you need to look at the India VIX.
The fear gauge.
Yeah. Ideally, you want the VIX to be relatively calm, say below 20 or 22. If the VIX is really high, like above 22 or 25, these mean reversion plays get much riskier. Things can swing wildly.
So high VIX means maybe stand aside.
Often, yes. You'd also glance around for positive factors. Are foreign institutional investors, the FIIs, buying? Is RBI policy stable? Are major sectors looking okay?
So in our April scenario,
Let's say the VIX is at a comfortable 16. FIIs are net buyers. No major scary news globally. Nifty's still above its 200-day SMA. That all supports the potential trade.
okay, context looks good. Volatility is low. Step 4 must be about timing the entry, waiting for the turn.
Exactly. Step 4 is waiting for confirmation of the reversal. Don't jump in just because it looks oversold. Avoid catching that falling knife.
So what confirms it?
You look for those bullish candlestick patterns to actually complete and hold. You want to see volume picking up on the green upward candles.
Shows conviction from buyers.
Yes. You want to see the RSI or stochastic starting to curl upwards, moving out of those oversold zones. Maybe the price finds support right at a key Fibonacci retracement level.
Adding confluence.
Right. It's about risk management. Don't enter prematurely. So
Yeah.
in April 2025, maybe after hitting 22,050, the next candle is a strong, bullish, engulfing one, closing higher at, say, 22,150.
Okay.
And importantly, it closes on increased volume. The RSI starts ticking up, maybe hits 32. Perhaps that 22,150 level also lines up with a 50% Fibonacci retracement from the last swing, and maybe the ADX indicator is around 20, suggesting it's not a runaway trend.
That sounds like solid confirmation.
I can-
Step 5, planning the actual trade.
Yep. Plan the trade the plan. Decide your entry maybe just after that confirmation candle closes, near 22,150. Set your stop loss.
Where does that go?
Logically, just below the recent low, maybe 22,000 in our case, or below the lower Bollinger Band. Given nifty swings, sometimes using the ATR, average true range, helps. Maybe 1.5 times ATR below your entry.
To avoid getting stopped out by noise.
Right. Then set your profit target. Where could it realistically go? Back to the mean, the 50-day SMA, upper Bollinger Band, next resistance level.
And the risk reward.
Crucial. Aim for at least 1 to 2. Your potential profit should be at least double your potential loss. So, entry 22,150, stop at 22,000, that's 150 points risk. Maybe target 22,400, that's 250 points potential reward. That fits.
Plan set. Step 6, execution and management.
Pull the trigger. You could use nifty futures, options, or ETFs. Options need care with strike and expiry selection.
Position sizing.
Key. Don't risk too much on one idea. Standard advice is 1–2% of your capital per trade. Once you're in, manage it. Exit at target. Or maybe trail your stop loss up as it moves your way.
Protect profits.
Exactly. And watch for signs the reversal is failing. In our example, buy nifty futures at 22,150. If it rallies to 22,400, you close the trade for a profit.
Simple enough in theory. But step 7 is about what can go wrong, right?
Yep.
Monitoring risks.
Yes, these setups fail. What if the price breaks below that recent low at 22,000, especially with high volume? That's a warning sign.
Or if the VIX suddenly spikes.
Yeah, VIX jumping back up towards 23 or higher. Danger signal. Keep an eye on global markets, RDI news, FII flows. Things can change fast.
So if those bad signs appear in our example,
You'd strongly consider exiting the trade, cutting your loss, even if it hasn't hit your initial stop loss yet. Respect the changing conditions.
okay, so just to quickly recap our hypothetical. Nifty uptrend, dips oversold near the lower band, low VIX, gets confirmation, plan with good risk reward, trade works out.
That's the ideal flow, yes. And a few more nifty specifics. Feedy flows matter a lot. Watch key banking stocks like HDFC Bank as bellwethers.
Global indices influence too.
Definitely. For instruments, futures, near-term options, ETFs are common. Use ATR for stops. Maybe avoid trades if VIX is above 2022. Daily or 4-hour charts work well.
And always limit risk, backtest the strategy.
Couldn't stress that enough. Backtest, backtest, backtest before using real capital.
So why might this strategy be somewhat suited to the Nifty 50, in stable times at least?
Well, the Nifty is very liquid, and historically, in stable or uptrending markets, it does tend to revert to the mean. You often see institutional buying emerge around those key moving averages or Bollinger Bands when it dips.
Providing some support.
Exactly. So by combining the setup with volatility checks and solid risk management, you're trying to align with that tendency.
Okay, so we've covered the core steps for this mean reversion idea on the Nifty. A lot to digest there.
It's a framework, a way of thinking.
Definitely. And here's a final thought to chew on. We talked about volatility with the VIX, but how could really digging into different types of volatility analysis or using more advanced risk techniques maybe refine this or indeed any trading approach you use?
That's a great point. Constantly refining your understanding of risk and market dynamics is key.
Exploring those nuances, that's where you might find a real edge. It really boils down to continuous learning, doesn't it? Being critical, being adaptable. That's probably the most valuable asset in the end.